Good evening and welcome to the FiTT Show, financial information for today and tomorrow. I'm Bobby P. Kinson,
And I'm Thomas Doty.
and we are the FiTT Show, helping our people get their finances in shape. How are you doing today, Thomas
I'm alive.
Doty?
All I can say about it. That's a good thing.
No, that's a good thing. You know what I'm saying? Because there's a lot of people woke up today dead. You know what I'm saying? So it's good that we're here, and thank you, oh God. And let's get this straight. Everybody thought last week we weren't on because of me.
Hmm.
They thought I had the flu.
It
And
wasn't you. It was me. I was sick.
it was dope. And you look so like you recovered so good though, because the other day, man, you look like death warmed over.
Yeah, I was pretty sick. I ain't felt that bad in a while. But by Saturday, I felt a little better. And
But so you had the flu bug, right?
I had no idea what it was. I had a head. My head felt like it was pounding. But got over it and doing okay.
Yeah, and nowadays there's so much stuff, so much bacteria out there, though you just can't imagine what the world is going on. I'm looking over here. They got with the Fit Show happening now, but it's actually running our old show. I don't know what's happening, but hope y'all can see us live because I have something else on the actual I mean not the YouTube on Facebook. Looks like I hope everybody. If you can see us, can you put in the comment box that you with us? I see Nal is with us. I see Garnett is with us. But anybody else, if you with us, can you put it in the comment box? Because sometimes we have these technical difficulties, which is out of our control. So, you know. Oh, hey, what's up, Cole Chapman? Thank you very much. And he said, "Dope, glad you're feeling better." Yes, Sierra. Yes,
You?
so good. So, Dope,
Yes, sir.
it's been 2 weeks. Is that correct?
Yes.
Yeah. 2 weeks since the last time we've seen you all. So we're hoping, Dope, that you got some great and astonishing. Oh, wait a minute, though. I'm sorry. I got to do the house cleaning stuff. I forgot. Else we be in big trouble, my brother. I got to show you all that we're not fiduciaries and we have no fiduciary. We're just giving you information, financial education information. So please remember that. And also, can you please click on the like button and the heart button because that actually how it works with algorithms. And you can click on as many times and please as many times as you can. I'm so thankful that you do that. And then also, we are virtual. Everybody knows that. But how to make this interactive, me and Dote in the studio, but you're not in the studio with us. But you can be if you put comments in the comment box. And that really, really, really helps a whole lot. So please do that. And we would really be so thankful if put, if you have any comments or any ideas or any thoughts, opinions, or some topics that you would like for us to actually cover in the future. And if the questions, we hope that they pertain to the show, which is today. But if it's something off, different than the show, so much really doesn't blend with the show, we promise you we'll get back to you about doing that or any questions you have about something else. But feel free to put questions, financial questions in the box. We will appreciate it. Hey, Linda, my sister Linda's on. Thank you, Linda. Dope. Um, please, before I go any further, there's two things I want to talk about. Um, uh, no, one thing. You ever seen the Austin Power series when they go $1 million, right? Well, there's another series in there, dope, where Austin Powers is talking to this guy. And he's got a big old mole with the hair hanging out, and he's trying to talk to him and not look at it, right? And he's like, trying to act like you don't see, but he can't see. He say, "Oh, moly, moly, moly." The reason why I'm saying that is I know y'all all see this sore on my lip. It's not a shanker. I want to get it over now, though. I want to get it over now. I know people around there making jokes and stuff, and I'm conscious about it, and I don't want to be conscious about it anymore. I was shaving, it's ingrown hair that goes in, and that's what happened. I'm sorry, I'm just conscious though, because I know people are like, "What's that on Bob's lip?" Because that's the first thing you said when you came on screen with me, though. So I covered that. I hope that answers everybody's questions. Thank you. So don't stop it.
No, keeping it real. Okay.
Keeping it real. Though, in case y'all don't remember, 2 weeks ago, our show was navigating volatile markets. That was so interesting, even to me. But this week, we're talking about investment principles to live by. And we got a lot of them. There's quite a few, it's even more than what we have, but we kind of condensed them into ones that are, really more key and so important. But there's so many others. But we try to pull up the most important ones for you. But before we do that, let's get into the show, though. What do you have for us on the stock market update?
And it's really interesting because it looks like not much has happened in the last 2 weeks, but it's really been a very volatile.
Crazy.
It's been up and down, and a lot of money.
Please let me know if you can see the screen.
I don't. Is it up?
Yes.
I see it, Bob. It's up. You're working.
Great. Thank you. Go ahead. Continue, please.
Yeah, and a lot of money is moving from the so-called Magnificent Seven to the other 493 stocks in the S&P 500. And you can see there hasn't been much change in the last couple of weeks or even year to date. I mean, we're almost through 2 months of the year, and the S&P is up 1%. And the NASDAQ has taken a nice little hit. It's up for the 2-week period, but year to date it's down a couple of percent. And then you look at the stocks I own and that I follow and kind of keep track of. You can see Microsoft is pretty much flat for the 2-week period, but it's been as high as 500 last year, so it's going through some change. Apple's up, Nvidia's down. Nvidia announced earnings yesterday, and again, they had a massive quarter, made gobs of money, but everyone's still nervous about the amount of money being spent on AI. I mean, everybody's capital budget, all the companies' capital budget to spend this year on AI is huge, and the market is kind of questioning whether that money is going to turn into something profitable. And what's going to happen as a result of all this money being spent. So that's why you see a lot of this volatility in the market right now. Google's down a couple and Pfizer's pretty much flat. So it looks like not much has happened, but a lot has gone on with earnings announcement. And both Microsoft and Nvidia announced fantastic earnings, but their stock you didn't see very, very positive changes in their stock prices, again, because of all the trepidation regarding how much money is being spent in AI. So it's going to be volatile for a while. Tomorrow, an inflation number comes out. You got the tariff turmoil going on. You got Ukraine, you got Iran, you got Venezuela. You got so many things going on. So the market's going to be extremely volatile over the next couple of months. And all we can tell you is, like we always do, is just hang in. If you're holding on to good stocks, hold on to them. Don't make any rash decisions. Don't run out and try to get out and get back in, because that typically doesn't work. And so just kind of hang in there and hope things kind of mellow out.
Right. So I was looking at the gold market, though, and the gold market is over 5,000 again. It's actually $5,191 an ounce. In 2017, gold was at $1,300 an ounce. and silver was at about $16 an ounce. Silver is now at 89. Right, $89. Let me see what percentage. What is that percentage gold on that gold? Let me see what that would be. Equals. Yeah, yeah,
I can get that for you pretty quick, Bobby.
yeah. I'm all. Yeah, I think I got it. Equal into uh, 1, 3. Damn, dope. That's a 300. That's almost a 300%. Whoa, that's almost a 300% return from 2019. Good gracious. So, just giving you those kind of stuff. And silver's up. And though we talk about mutual funds and ETFs and index funds, right? I just want to show you I was tracking a Fidelity Growth Blue Chip Fund, which I had about almost 3 years now, right? Not a total of 3 years. And it grew from 21,000 to 54,000, which is 160%. Can you believe that though?
Oh yeah. I mean,
I had another fund, which is the index fund. It was at 400 and it was at 4,457, right? And let me just do the math on this right quick. 4,457 minus into, yeah, wow. That return though is right quick. Just tell y'all 200. That's just in almost 3 years though. The 235 return, 4,457. It grew right. Yeah, I'm like, did I do the math right? And we say this, and we're not advising you invest in the stocks. We just sharing you with the stocks and securities that we have, just to show you the growth real time. We're just not talking the talk. We walking the walk, and that's the only reason why we're doing this, so you can actually see that being in the market pays off. And we even in bonds, right? Me and Dope got bonds, right? Dope, what were the bonds paying, Dope?
We got in when they were about paying a little over 9%. I got out of them because right now they aren't paying a very good rate, and I'm a little. Right,
it's about 4%.
Yeah, I'm a little bit afraid of bonds right now because typically, with interest rates going down, bond prices usually take a beating, and
right.
There is still some talk that the Fed's going to lower interest rates again. That's kind of in question now because I think inflation is going to rear its ugly head again. I don't think these tariffs are being taken into account. I'm just a little leery of bonds right now. But I think the point you're making, Bob, is the market has been on a bull run for several years now, actually longer than most bull runs have gone. And anybody invested in anything in the stock market pretty much has made some money. And that's no guarantee that it's not going to go down in the future. But we always show you that over the long haul, the S&P has averaged between 10 and 11% a year. And we both invest in the stocks, and we both done quite well. And we think that's a way to build wealth over the long haul. It's not for everybody. It's not. You have to understand your risk level. You have to understand that it can go down. It can go down pretty quickly, as it has in the past. But over the long haul, S&P has averaged around between 10 and 11%. And some of the other things, gold is going crazy right now, but that could change pretty quickly. A lot of that's happening because of the devaluation of the dollar and a lot of it's people's fears about what's going to happen, the deficit. There's a lot of reasons that gold is continuing to rally, but I'm not sure how that's going to continue. No, obviously nobody knows, but as I told you before, I'm invested in gold. I've done quite well. I think I was telling Bob, I'm up about 3 times of what I put in. And so we always talk about being diversified. So you put a little money here, a little money there, and on average, things should go up for you.
And though, right quick, I just want to address a lot of people, watch this show, or people know that, I've been into, as an investment advisor and things like that. And I follow the market. They ask me, Bob, how do I know when to get in or when to get out, or how long to hold, or when to fold? Do you have any advice for them?
You get in anytime you can, as soon as you can. And that's what we always say, that the biggest asset when it comes to investing is time. And so you get in whenever you can. As far as getting out, that's a tough one. Again, a lot of this depends on your particular situation, what your money needs are, what your plans are, what your goals are, short term and long term. And so there's no cookie cutter answer for when to get in and when to get out. But the most important thing is to start investing as soon as you can. And the longer you can be in the market, the more likely you're going to be to be on the positive side of things. So I'm not a get in and get out person. You have to get in and pretty much stay in for the long haul. Now, for example, if you're about to retire, okay, if you're close to retirement and you want to depend on your savings to live off, let's say you're going to live off the interest on your savings. Well, obviously, you wouldn't want to be heavily invested in the stock market you wouldn't want to put that money at risk if you are planning to live off that money. So a lot of those situations are unique to your particular case or what you're trying to do, what you're trying to accomplish. So like I said, there's no cookie cutter answer, but the best time to get in the market is right now.
Right. And when y'all see, because Dote's been saying this, and I feel the same way, it seems like there's going to be a bubble, and that bubble is going to burst because it's been going up, and then historically it has never been, if I think I'm right though, a bull market as long as it has been over the years.
But again, people have been saying that for the last 3 or 4 years, right?
Longer than that, though. I think about, shoot, I know for a fact at least 6 or 7 they've been saying.
Oh, it's going blow, it's going, and eventually it's going to.
It is.
That's a fact. But again, we always argue. Excuse me. You can't worry about that because typically, by the time it goes down, you'll be up enough that the fact that if you're up 100 and it goes down 20, you're still up 80, and that's how you have to look at it.
Right.
And you're looking long term, and so it's very difficult to time the market, and professionals can't do it. And I know people who are just looking to invest should not concern themselves with that because it's much too complicated. But the key is to get in that with very good stocks. Okay, that's what you want to do.
And what most people do, they buy high and sell low. The key is to buy low and sell high.
Well, and again, we always talk about that, Bob. That's when people buy when everybody else is buying, and when things are going up, people buy and sell when everybody else is selling. That's selling low. And if you buy consistently, you take advantage of dollar cost averaging. Your average cost per share will be lower if you continually buy. But yeah, if you want to build wealth, that's the easiest. That's one of the easy ways to do it is through the stock market.
And don't want to share this because a person did a review for me with real estate, right? And what's happening with real estate, right? People were they were selling their house when it was high, right? But with real estate, this scenario happened. They were selling while their house was high, but what they found out, they were buying the new house while it was high.
Yeah, if you sell high, you got to live somewhere.
Right.
Yeah, unless you're downsizing, you really aren't changing anything, just probably getting more debt. And with interest rates being what they are, it's not a good time to buy because a lot of people are sitting on 2 and 3% mortgage rates, and mortgage rates just tipped below 6% for the first time since 2022.
Right.
It's a big jump from 3 to 6% in mortgage rates. I'm telling you that's huge.
That's huge. That's big. Yeah. So I mean, I forgot how the actual math, uh, how they to see what that is, but that from a 6 to a 3, that could be anywhere between $300 to $600, maybe. Is that
Depends on what
the
depends on what the mortgage balance is. Obviously.
Right. That's what I said. I know it depends on what that is, but we're talking about somewhere in that range of
It's
different
huge.
mortgage payments.
Yeah. It's huge.
It's huge, man. It's huge. So let me talk about dope. We're talking about how the market can go down on your butt. Let's talk about cryptocurrency. Cryptocurrency is remember it was up to what was it?
105.
Yeah, I'm talking about the total market was, I could have swore it was about 4 trillion at one time. It's down to 2.4.
Yeah, a lot of the people who made money on that have gotten out and
Right.
kind of on the sidelines now.
Right. And just to show you cryptocurrency, it's up $429. The Bitcoin it's at $67,266. But a year ago, or the beginning of the year, I think it was as high as a year ago. I'm sorry, it's about 121,000 per Bitcoin. So this is how volatile cryptocurrency is. Ethereum, which is smart contracts, it's up $77 to $2,022, and Tether is down, which is actually it took the third place. It was in fourth place, and Ripple went above Ripple, which is a stable coin, which they're getting ready to regulate stable coins, and I think you'll be able to get stable coins in the bank. But the other cryptocurrencies, they're not regulating them yet. But that Ripple, the stable coin, actually lost a cent. It was like down to $1.40 a cryptocurrency for Ripple. And then Binance, which is another smart contract, that's up 3%, $17, up $17 cryptocurrency at $624. So it's a little bit cheaper for you to get in. So anyway, that's the cryptocurrency market. As we say, it's so volatile, so speculative, and the whole point is they're trying to make it a like the dollar where people can purchase products and things like that, which is they call peer-to-peer, cut the middleman out, and you can go directly to the store. Now have no Visa in between, no MasterCard, and that's supposed to be the whole philosophy of cryptocurrency, that it's a straight cryptocurrency and it'll save you money by cutting the middleman out. But it's not there yet. So, hold your breath and remember it's for the long play. So, let's get into our show for today, which is investment strategies to live by.
Yeah, and Bob, it's learning how to invest. It's not simple. It's a complicated process. I think the more we talk about it, the more we understand how complex it can be because of all the variables involved with the things you can control, like what you do, what your plans are, and then the things you can't control, like taxes, economic issues, political issues, natural disasters. And so what we try to get you to do is to pick up some of the things that learning from the best, learning from folks who know what they're doing, but also you can learn from people who don't know what they're doing and things to avoid. And there's a lot of things you consider when investing, and that's what we're going to talk about today. There's no simple way. That you could think you could just take your money, put it in the bank, and just live happily ever after. But we always talk about the purchasing power you lose through inflation. And what we want you to understand is to make money in the market, to invest, to manage to grow wealth and manage your financial life It's going to take some time. It's going to take effort, patience, and a lot of work. It'll take a lot of work.
Yeah, yeah, and that's just a fact to the matter. But when you start investing on your own, the world of investing may seem overwhelming, and often with too many choices and confusion about how to start. A good investment strategy minimizes your risk while maximizing your potential return. But with any strategy, it's vital to remember you can lose money in the short run if you're investing in a market-based securities like stocks and bonds. That's why it's a good idea to have other finances, including, we always talk about emergency savings in order, before you start investing. So remember that. And remember, good investment strategy also takes time to show results and should not be considered a get rich quick scheme. So it's important to begin investing and realistic expectations of what you can and can achieve. So, Dope, let's get into some of the investment strategies to live by.
Well, one of the first is not expecting too much or using someone else's expectations to drive what you do. So, when you invest for the long term, you got to create a well-diversified portfolio that works for you, okay? That has the appropriate level of risk, and it will supply returns that you are trying to accomplish to meet your own goals. And so even if you design the right portfolio, the market could act different than you expect it to, and it may not end up where you need it to be. And you have to expect that, and you try to build that into your plan. But understand, nobody can tell you what a reasonable rate of return is or how much risk you should have without having an understanding of what you're trying to accomplish, okay? And that's where you have to start figuring out what your goals are, what your risk level is, and that's the beginning. So you can get a feel for what you expect, but that's based on you and no one else. No one can tell you that information.
No, that's definitely good advice. And this is a good one, though. Not having clear investment goals. If you don't know where you're going, you'll probably end up somewhere else. That's an old saying. It's as true. That is as true as in investing as anything else. Everything from investment plan to strategies used, the portfolio design, and even the individual securities can be configured with your life objectives in mind. That's the key. Have your goals and objectives in mind. Too many investors focus on the latest investment fad or maximizing short-term investment returns instead of designing an investment portfolio that has a high probability of achieving long-term investment objectives.
Yeah, and one of the things that's really important is and we talk about this all the time, is diversification. And again, you can sit back and say, well, if you'd have put all your money in Nvidia, you'd be crazy rich now. But that's a poor recipe for success, because Nvidia could have very easily have gone the other way. So the only way to create a portfolio that has a potential to provide you an appropriate level of risk and return is to be adequately diversified. And by that, we mean you have your money spread in different pockets, different segments, in different markets. Like right now, the European market is doing much better than the US market. So we can talk about regional diversification. We also often talk about having money between stocks, bonds, cash equivalents. We talk about cryptocurrency. We talk about commodities. There's a bunch of different places that you can have your money to spread your risk. So, because typically when one particular market goes up, that usually takes money from another area. So you want to have your money spread. The old saying, you don't want too many eggs in one basket in case that basket falls and all your eggs crack, right? And so you got to be diversified. It reduces your exposure to the market and allows you, at some point, you'll have something usually that's doing well. Very seldom will every particular every particular component of the market be doing poorly all at one time. So again, this isn't a get-rich scheme. This is a slow but sure way to build wealth. You got to have diversification.
And though this is another interesting one that people do, focusing on the wrong kind of performance. Let me tell you, there are only two time frames that are important to keep in mind: the short term and everything else. If you are a long-term investor, speculating on performance in the short term can be a recipe for disaster because it can make you second guess your strategy and motivate short-term portfolio modifications. But looking past near-term voices and people telling you to the factors that drive long-term performance is a worthy undertaking. If you find yourself looking short-term, refocus.
That's for sure. And we touched on this earlier, buying low and selling high. And again, that's if you could pick one thing to have go your way, that's what you'd want to do. You'd want to buy low and sell high. But typically, people's emotions get involved. They either get greedy or afraid. And when you're greedy, that tends to lead you to buy the latest thing that's going well, that's already high. And it's following the herd, buying something that's already been on a really good streak. By the same token, fear can make you sell at the wrong time when everyone else is afraid and your stock is going down. And we always remind you that you don't really lose any money until you sell, okay? You got to have patience. And if the fundamentals that causes you to buy a stock change, that's when you might want to consider selling. But you don't want to sell because of what's going on in the market if you have a good stock. You invest for the long haul and you buy a good stock. And as long as it meets your qualifications or the reasons that you bought it, then you hold on to it.
Trading too much and too often. When investing, patience is a virtue. Often it takes time to gain the ultimate benefits of an investment and asset allocation strategy, right? Continued modification of investment tactics and portfolio composition can not only reduce returns through greater transaction fees, it can also result in taking unanticipated and uncompensated risks. You should always be sure you are on track, though, and use the impulse to reconfigure your investment portfolio as a prompt to learn more about your assets you hold instead of, the ones that you go out and trade.
Yeah, you got to pay attention to what you're paying to trade.
Oh, that's a big one.
Yeah, you don't want to pay too much in fees and commissions. You need to understand how you're paying. If you're using an advisor or a brokerage firm, make sure you understand the fee structure. Make sure you understand if you're buying a mutual fund, what the fees are. You understand the tax implications. And typically, you can find the charges for the particular mutual funds or ETFs. And just because they have a higher fee doesn't always mean they perform better. And that's when you have to do your due diligence and you can look at the information, see how it's performed in the past, and you can get a feel for what the fees are. But you don't want to overpay. You want to make sure you understand what you're paying and why.
People, they they lose sight on this one though, especially when we start talking taxes. People just get so strange and weird. Don't want to pay too much taxes, don't want to pay no tax at all. But focusing too much on taxes, although making investment decisions on the basis of tax, the potential tax consequences, that's like the tail wagging the dog or putting the cart before the horse. Now, a common mistake that people make in investing is just focusing on the tax consequences. Now, you should be smart about taxes. Don't get me wrong. Tax loss harvesting can improve your returns significantly. But it is important that you buy and sell a security driven by its merits, not just its tax consequences.
Okay, you have to review your investments regularly. You go through the effort of creating a portfolio with certain percentages. Let's say you do 60 stocks, 40 bonds, and things change within, over time. One particular part of your portfolio may go up, another part may go down. You have to review your portfolio to make sure you are in balance with your desired risk level. For example, if you happen to have a whole lot of money invested in NVIDIA, that part of your portfolio is going to be a lot higher than the rest of your portfolio. So you might need to pull some of that out to keep your risk level where you're comfortable. So you got to review, rebalance, take a look at things on a regular basis.
So, Doug, what would you say is a regular basis?
It again depends on what you have and how you're invested. I mean, I look at mine every day because I'm retired and that's kind of one of my hobbies. But if you're not financially inclined, I would say at least a monthly basis. When you get your monthly statement, look and see how things have happened over that month and kind of get a feel that you're still within your guidelines for where you want to be invested.
And the worst case scenario, at least once a year.
If you're only looking at it once a year, you all kind of things could happen that you would have missed. That won't work for anybody.
Right.
If you're only looking at your stuff once a year, there's times you ought to look at it for tax reasons. There are times you ought to look at it for rebalancing. There are times you ought to look at it to make sure what you've invested in is doing as you want it to do. Yeah, once a year is not enough. I would think a minimum would be quarterly, but monthly would be my optimal minimal review.
You brought up risk though, and this is a good time for me to talk about this investment principle: taking too much or taking too little, or the wrong risk. Like investment involves taking some level of risk in exchange for potential reward. Our theme though, no risk it, no biscuit. But taking too much risk can lead to a large variations in investment portfolio that may be outside your comfort zone. Because you want to be able to sleep at night. You know what I mean? Taking too little risk can result in returns too low to achieve your financial goals. You got some goals you're trying to reach them, but you're not taking enough risk to generate the level to reach your goals. That's another one. So make sure that you know your financial and emotional ability to take risks and recognize the investment risks you are taking.
Another one, Bob, is understanding the performance of your investments. And I'll give you an example. If you're using an advisor, and it might be simple to say, you should do at least as well as the S&P 500 does. But that's not really a fair measure because the S&P 500 that's assuming you're 100% invested in stocks. So for example, let's say the S&P 500 did 10% and your portfolio is 60/40. Okay, you can't expect to have the same results as the S&P 500 because you're not fully invested in stocks. But you should at least be 60% of what the S&P did because you're not taking the same level of risk by having all your investments in stock. So you really have to understand what performance you're expecting in order to gauge if the advisor you're using is meeting the requirements that you've set forth. You have to have a way to evaluate whether whether the person you're working with is reaching your goals or whether you're doing good enough yourself to meet where you need to be. So you got to understand how you're going to measure the performance that you achieve.
Another strategy is, don't be reacting to the media, right? A lot of people listen to the media and that drives their emotions on, their investment portfolios. There are plenty of 24-hour news channels that make money by showing tradable information. It would be foolish to try to keep up. The key is to try to sort through the valuable information out of all the noise. Successful and seasoned investors gather information from several different sources and conduct their own proprietary research and analysis. Use the news as a sole source of investment analysis is a common investor mistake. But because, the time and the information, it becomes public, it has already been factored in the market pricing. So one of the strategies is don't be, looking and listening and using the media as your sole source.
Yeah, and back to understanding the performance. If you're looking at a stock, it may have a dividend attached to it, okay? Which there's two components of that stock's performance is how much the stock goes up and what kind of yield you get on the dividend. Again, you have to fully understand what you're trying to accomplish, okay? And understand that particular investment may have two components, or if you're looking at just a money market, then yield is the only thing that matters. But you have to look at the whole picture. For example, you may have a money market that's paying 4%, but you may be able to get a tax-free bond that's paying 3.5%. And so again, you have to understand what it is you're trying to accomplish and what you expect from that particular investment. You have to understand the whole picture and the tax consequences of that yield. So it doesn't matter how much you get. As we always tell you, what matters is how much you keep. So you have to understand the tax consequences of that investment also.
And this strategy is about time in the market versus trying to timing the market. Now, timing the market is possible, but very, very, very hard. For people who are not well trained, trying to make a well-timed call can be, their demise. Investor that was out of the market during the top 10 trading days for the Standard & Poor's 500 index, though, were from 1993 to 2013. That's 10 years, right? Is that right? 10 years. No, that's not 10 years. It's 20 years. You would have achieved. Now, if you miss 10 of the trading days, right, from 1993 to 2023, you would have achieved a 5.4% annualized return instead of a 9.2% by staying invested. This difference suggests that investors are better off contributing consistently. Me and Doe talk about that all the time. Dollar cost averaging, consistently, being in the market. Consistently, it's contributing consistently to your investment portfolio rather than trying to trade in and out in an attempt to time the market.
Yeah, and we often talk about how complex this is. You have to determine if you need help. And I would think most people do. I know there's situations where I consider myself fairly financially literate, but there are situations where I also need help. There's just too many variables involved when you look at taxes, when you look at different phases of life, how many things change. Um, if you need help, you have to get help, but that help has to be the right help. Okay. So you might get the wrong person, and make sure you're working with the right person. Or if you're doing it yourself, make sure you know enough to cover all the things that may be involved.
Hey, next one is working with the right advisor. An investment advisor should be your partner in achieving your financial goals. You know, the ideal financial professional and financial service provider not only has the ability to solve your problem, but shares a similar philosophy about investing and even life in general that you have. The benefits of taking extra time to find the right advisor far outweighs making a quick decision. Um, and this is one of the signs of picking the wrong advisor. If you get with a financial advisor and the first thing they say to you is, hey, you need to look into investing into this growth fund, that should be the first sign right there. Or you should be looking to get, index universal life insurance. First, without them first talking to you about understanding what your goals, what your philosophy, what your risk level is, what your time horizon is, not theirs, yours. That's the first sign that that's not a good advisor. First thing they should find out what you want to do and get in line with your philosophy.
And the thing about having a good advisor is everybody's going to get emotional when it comes to their finances.
Yeah, buddy.
And when you get emotional, you typically are going to make poor decisions. And that's another reason where to have an advisor. And if you don't have an advisor, at least have someone you can talk to who's not emotionally tied to your situation to kind of keep you grounded, to keep you from making a decision based just on emotion. Because you should be making decisions based on facts, based on solid data. There's so much information available for you to use to make a good investment decision. Okay, you can actually use AI to pick investments for you if you give it the right uh, components of your particular situation. But you don't want to get emotional. You don't want to get greedy. You don't want to get em- uh, make a decision based on fear. You want to make decisions based on solid financial information.
This is another important uh, investment thought, and people miss this one. They forget about inflation because most investors focus on nominal returns instead of real returns. Now, what does that mean? Nominal real returns means looking at and comparing the performance after fees and inflation. That's the real return, right? And that tells you what your portfolio is really earning. Even if the economy is not in a massive inflationary purpose, some costs will still rise. It's important to remember what you can buy with the assets you have is in many ways more important than the value in the dollar terms, meaning, the value of your assets is more important. And what you look at adjusting, which really look first to be disciplined and focus on what is really important. And what is most important is your returns after adjusting for rising costs.
And one of the things we're talking about is how important it is to start and continue to invest. It's just, and so now we've talked about a lot of these strategies and how important it is to understand how much effort. But let me give a scenario for the people who are sitting there thinking it's too much work. I don't want to be bothered with it. At a minimum, what you want to do is take a portion of the money you're going to save and invest it in an S&P index fund, and just not, for those who don't want to worry about picking stocks or don't want to worry about diversifying or don't want to worry about asset allocation or rebalancing. Let's say you want to save 10% of your money, and you don't want the hassle of having an advisor, or you just don't feel like that's overwhelming to you. Then if you want to take 10% and save, take 6% of that, invest it into an S&P index fund via mutual fund or ETF, and just forget about it and just let that money grow for you. You'll still need to talk to a tax advisor at some point to make sure you're okay with Uncle Sam, because you never want to get out of balance with Uncle Sam. But that would be the extreme minimal knowledge, minimal effort, minimal thoughts about what's the least work I can do and still invest. Take a portion of what you plan to save, put it in an index fund, and forget about it. And that's the absolute minimum. But it's really important that you do, if you're trying to build wealth, it's really important that you put a portion of your savings into the stock market, into an investment, in order to get some growth over a long period of time.
Yeah, and the last one is plain and simple. It's about controlling what you can, right? Like, people like to say that they can't tell the future, but they neglect to mention that you can take action to shape it. You can't control what the market will bear, but you can save more money. Continually investing capital over time can have as much influence on your wealth accumulation as the return on the investment. And that's what we always constantly talk about, being consistent in investing, being steady in investing. And that's a little bit more important than sometimes the return itself. It's about the accumulation. And it's the easiest, sure way to increase the probability of reaching your financial goals.
Hey Bob, and I gave the minimum effort, right? Just take X amount of money, put it in an S&P fund, and forget about it. But on the other end, the way to do it the right way is to do the things we just talked about in this presentation we just gave, and do some research, understand what your risk level is, understand what your goals are, review different phases of your life, what kind of things you can expect if you plan on buying a house, if you plan on paying for college, if you're planning for retirement. Understand what those goals are and develop strategies to meet those goals. Understanding the tax code. Okay, you can't play a game unless you understand the rules. Okay, and if you want to maximize your, or minimize the taxes you pay and maximize your returns, then you have to understand the tax code, or have someone who does understand that, so you can maximize your return. It's talking to people who have accomplished what you're trying to accomplish, so you can prepare for the things that are coming that you will only go through once in your life. Okay, like retirement. That's something that everybody goes through once, and I would venture to say a lot of people make mistakes in that because one, they haven't been through it and they haven't talked to enough people who have gone through it. And look, I can say my biggest regret about retiring, the thing I miss most about working is having somebody doing a lot of the stuff that I hate to do. Like I just had to renew my passport. I've never had to do that. I could always throw that to somebody and say, "Hey, make that happen." But those are the kind of things that's a minor thing, but those are the things you need to find out before you retire, so you can understand what that situation is like. You can understand about things like IRMA, things like when to take your Social Security, how do you handle your required minimum distributions, where you should be invested in before you retire. Those are conversations you need to have, or information you need to learn by some method. Okay, if you want to be on top of things, if you want to maximize your wealth, and it does. It takes a lot of time, a lot of effort, a lot of work, and that's the extreme case versus the minimal case.
Yeah, that's good stuff though. Great, great, great. We had that was a long list, you all. We know that was, but and it's even more than that out there. But we try to condense it down, and that was really a lot of good stuff though. And when I was preparing for this, and we going over it again, man, it was reminding me of some things that I must really consider and keep in mind. So we hope that really helps everybody. So, let's go to the actual summary and takeaways of today's lesson.
And first, we said it 100 times. It's going to take time, effort, and patience to build wealth. Okay, it's not easy. It's a lot of work, but there's nothing better than not having to worry about money.
Be clear about your investment goals. That's the most important things. Like I said, if you don't know how where you're going, how you're going to get there. So it's so important to have clear investment goals. Investment goals that are ones that are specific, measurable, achievable, um, and being able to realistic, and have a time frame.
You got to find the right risk for you. Bob's risk is not my risk. My risk is not his risk. You got to find where you're comfortable. That eliminates you having regrets about what you've invested in. If you're comfortable with the amount of risk you're taking, you understand what the upsides are and you understand what the downsides are. And you won't be killing yourself when things don't happen the way you anticipated. Remember, it's not one size fit all. It's not what somebody else does or what somebody else says. You have to determine what risk level you're willing to live with.
So it's just like you have to determine the risk. The whole key to it all is developing your strategy, not Dote's strategy, not Bob's strategy, but your strategy. And the key is to have a strategy. Let me tell you all, I see so many people, all over the place, up, down, left, right, all over the place because they don't have a system. That's all the strategy is. The strategy is having a system, whether it's good, bad, whether it's the most profitable, wealthiest strategy ever. Yeah, that's good, but the key is to have one. You must have a system. Just like on, spending your money, you gotta have a budget. You gotta have a system to make this work. And please, at the end of the day, it's all about developing a strategy that's for you. So, with that, Dope, I like to end today. Uh, Kitty is a Virginia State Kitty Cheney, the Toastmaster International Extraordinaire. She is a Virginia State University grad from Virginia, Oh God, there. Which Kitty put in there? Oh God, I'm forgetting the place you are from down there in Virginia, where all those slaves were, and they all made it safely out of there. Oh, put it in the chat, Kitty. But Kitty said, though this weekend is the CIAA tournament in Baltimore, and Virginia State has made it to the semifinals. Way to go! Way to go! Way to go!
It used to be in Charlotte, but I
Yes.
think the hotels in Charlotte were overcharging all of us. And so they said, the heck with y'all, and they moved to Baltimore.
Wow. Well, like how we all in the Envy Show, we got to give a shout out to all y'all wonderful people to take time to listen to us and encourage us and concerned about our health and everything like that too. Thank you. Starting off at the top. Now, Dodie. What's up? Now, Nisi Dodie. Hey, what's up, Garnett? My little brother, Cole Chapman. Glad to see you here. Though we're so fortunate today, all three of the Kansas sisters are on today. Linda, who turned 80 years old last week for last. Gloria and Nolia. And that's actually the order of their ages. Thank you all for being on. I love my sisters so much. They always support little brother, so thank you. No, and the wonderful and great Modestine. Modestine gets the silver banner for being on here. I think more than anybody. Now Garnett's in there too. I gotta admit, but Modestine was in there even before that. So thank you, Modestine, for always staying with us. Rodney L. Madison Sr. Man, we had a good time yesterday with the fellas from the FDIC. Dope. We sold some stories. We met. 3 of us are retired, and 1 is still working. Andre Robinson, Rodney Madison, and Calvin Drakeford. Man, we had some stories, boy. We need to put a book out. Behind the Banking Crisis. It'll be pretty good. Deborah Doty, what's up, Dee? What's up, Dee? Glad to see you. And, hello there, Gloria, once again. Oh, dope. My main Apple Scrapple, Michael Graham, the enforcer 1994 NCAA championship with Georgetown University. Michael,
1994.
Huh?
I think you got the date wrong, don't you?
What did I say?
You said 94.
It's 84.
There you go.
Thank you very much, Dope. He ain't that damn young. Hey, Mike, that Dope. Michael Graham, and for all you people who are in Washington, D.C., is running for the at-large position, councilman in Washington, D.C. For the upcoming year. So wish you well, Mike. I'm helping him out. We're doing a lot of things. We still need a lot of signatures. So anybody who's interested in supporting Mike, he's trying to help the homeless and the aging in the Washington, D.C. area, and trying to help people with financial literacy too. So thanks, Mike, for being on. Oh, no, Joanne Skinner. That's Joanne was another one that gets the silver banner, like Garnett and Modestine and Linda and Gloria and Nolia. But Joanne has been here a long time too. So thank you so much. And I think I covered everybody, Dope. Yes, I did. Yes, I did. So thank you all, but Dope.
Hey, Bob, you didn't mention your, because I guess you're being modest about getting published.
I mean, Dope, you know me, I'm not a person that usually talk about.
Okay, stop it.
Why you laughing? I didn't even get it out.
I know what you did.
I didn't even get the daggone stuff out. Jesus. But yes, you all, I got a public relations firm got interviewed me and put an article out. And they usually put it in USA Today, Wall Street Journal, all these major publications. And they actually, but the publication has accepted. They just inquire and try to place them. And 4 major publications, Profit Fortune, CEO Now, major business in all the four together. There was all three business journals. It was talked about me and my book and my career in finance, and a wellness publication, which reaches over 10 million people, though. So hopefully my book sales will pick up, and also not just my book sales, my speaking engagements, and that's what it's all about. So yeah, I'm fortunate though to get 4 major publications, international. So really thankful for that, and looking for the payday from that. So thank you though for letting me be able to mention that. So the quote of the day: understanding yourself is power. Forgiving yourself is freedom. Loving yourself is peace. Being yourself is bliss. That's my thought.
I like that one. That's what they say to yourself, because everybody else is taken.
That's a good one too, though. I like that one. So everybody, see you next week, same bat channel. Next week is going to be March, isn't it, dope?
In the March.
It begins March. Oh God, the 5th. Good gracious, March here already. And that's the time goes back to the week after that. I mean, swing forward. Time goes forward the week after that. God, we there already. So get your spring cleaning together, everybody. And that means your finances too, not just your house. See y'all then. Look forward to seeing you.
Not to mention, a lot of Social Security scams out there. Don't fall for them.
What you mean?
People are really pushing Social Security scams. And the key things to watch out for, if there's urgency, they're saying you got to do something right now, or they're saying you got to pay, you know it's false. The Social Security Administration will not call you and tell you you have to pay immediately or that anything is urgent. Stay on top of your information. I told you, get your taxes filed. If you haven't filed your taxes, get that done. Get that PIN number we talked about. But scammers are working hard to steal your information. Please stay on top of your stuff.
No, Social Security does not call you.
Yep, not at all. Oh,
IRS do not call you.
But I forgot, if you haven't created an account on mysocialsecurity.gov, myssa.gov, you need to go out and do that, because that will create, you'll get notification if somebody tries to change any of your information, like your address, your benefits, your banking information. So if you don't have a My Social Security account, you need to go set one up. Okay, I don't care, even if you're young, you need to do that,
right?
Because you keep track to make sure your earnings are reported correctly. So everyone should have a My Social Security account, and I hope everyone who listens to us has done that.
No, that's a very good one, Doug. I forgot about that. So thank everybody. Thank you so much, and may the peace of God be with you. And we see you next week. And don't forget to tell somebody, share with Facebook, and subscribe on YouTube. Have a wonderful day.